So I want to start out with our mission and vision. And I want you to kind of keep that in mind as we roll through the next number of slides. Our mission at Innovation is to provide world-class financial services wherever you are and wherever you need us. And our vision is to be the most responsive and innovative financial institution. So when we looked at the build of our vision, we drew on a number of different things. One is input from our membership, the prevailing environment. The other one is cooperative principles. We believe that as we do a lot of things in our organization and we stay true to the essence of a cooperative, a credit union, it helps us create a clear line of sight as we move forward as an organization. So when you look at the list of principles that we have on the screen, I want you to keep in mind that in relation to our vision, in relation to the 2015 that I want to go through, and also in relation to the future as we move forward. We use a balanced scorecard at Innovation. There's a number of ways to plan as an organization and move your organization forward. We adopted the balanced scorecard a while ago. The big reason that I like the balanced scorecard is it allows organizations to focus on more than just driving profits. Our two main categories, or most important categories, are our people and our members. And of course, we are running a business, so we have to pay attention to certain things to make sure we're long-term viable, and also we have to make sure we return appropriate returns back to our balance sheet, and in our case, back to our membership. Of course, we are in the business of granting credit, so risk is also a consideration that we ensure that we talk about when we're looking at planning and organizing our efforts as an organization. So this is our scorecard. I'm going to have a few slides and a video at the end, but I'm going to have a few slides to talk about some of the points in our scorecard and just give you an idea how 2015 went. So let's talk about people. Our process in Innovation is if we have engaged leadership, we'll have engaged staff, engaged people, which means that we'll engage effectively with our membership. So we monitor our engagement very closely, and we've been moving the gauge considerably over the last number of years. And this is important to us because our industry and our organization is going through transformational times. So we have to make sure that we're constantly investing into a very important group, and that is our people, to ensure that we can move forward. Last year we moved up 8 points to 59. We're still on a journey to get even higher, but we're very excited about the results. So we wanted 59, we got 59. And again, very important, the supplier that we work with has indicated to us that if you can get 2 to 3% a year, you're doing good. And it's no surprise to me that the staff at Innovation did 4 times what they thought we would do. Training, very important element in our organization. If you look at our year-over-year investment, we continue to invest into training, whether it's personal development or corporate development. This gives you an idea of how well we did. We budgeted for in and around $2,500 per staff. We were a little bit shy on that, but the nice thing is that we had around 95% of our staff fully engaged in some sort of training throughout the year. Again, very important so that we can provide quality advice to our members and service. Volunteerism, again, something that we measure as an organization. We view this as one of our key differentiators when you look at the co-op principles and how we stack up against the competition. So last year our staff contributed over 1,100 hours to the communities and the regions that we work in. 91% of our staff are qualify in that category. The other thing that we did a year ago, just to make sure that we don't fall back too much on the volunteerism, because as you know, life is busy and there's a whole bunch of things competing for our time. We actually introduced a program at Innovation that allows our staff to take a full day off of work and go out and do something for the community or volunteer in some way. And again, that's our effort to ensure that we stay true to the commitment to our community. The next part is growth, and really the growth for us is really the focus that we have on our membership. So some of the things we look at in this category are a concept we call Net Promoter Score. And so really what we do is we go through a process with our members to understand some of the detractors, some of the things that are promoting our organization, and then there's the passive. So it's a real a real simple tool, but the work that we go through to work with our membership provides us with a lot of information on how we can move forward as an organization. Again, it's very important that if we have an engaged staff group, that we engage our members and and keep them top of mind. So if you look at how we stack up in the industry, and we're focusing here on Saskatchewan, we've come a long ways, and very proud to say that innovation, when we compare ourselves to the competition, is #1 in the province. So if you look at the I guess the mechanism that we've deployed to ensure that we're remaining relevant to our membership, it's worked very well for us as an organization. So the other thing that we measure consistently in our organization is our investment. Again, a key differentiator for us, we believe, is our investment back into the community. So if you look at 2015, we contributed around $436,000 back to the communities and the regions that we support. And we have a range that we look at, and we try and keep it between 2% and 4%. And if you look at the graph here, you can see we've kept that range. One of the things that we did a couple years ago, and we do on an annual basis, we go to our membership and say, how are we doing in the community? And get feedback from our owners and our members. And one of the things that they said to us is that we love your commitment. You're way above or better than the competition. But we find that perhaps you're maybe you don't have to be platinum at every event. And so we heard that, and as if you can see back in 2012, we started to massage the level of commitment into the community so that we still remain between that 2% and 4%, but it's a bit closer to 2%. The nice thing about the program that we run is it's tied to profits. So between 2% and 4% of our pre-tax profit goes back to our community. So as we grow as an organization, as our communities grow, then so does our contribution back to the community. So it's a really good program in our mind, and we like to share it on an annual basis. The other thing I wanted to show you too is growth when it comes to membership. In Canada, the research indicates that we've been experiencing as a credit union system a decline in membership, and there are pockets where that's not necessarily the case. At Innovation, we didn't want to have that that situation in our region, so we've been working really hard with our membership. We've been launching things like Freestyle. We've been focused on membership growth because we believe for long-term viability, we need to have a situation where the new members outpace the members that move from our trading area or no longer part of our organization. So I'm proud to say in 2015 we had over 580 net new members as an organization. As you can see in the graph, we've reversed the trend that we wanted to. And again, something I wanted to share with you guys this evening because it's a very powerful statement for the work that our staff is doing in order to ensure we're long-term viable. Of course, I have to talk about finance because our CFO Sheldon's here, and that's, again, a very important part of our balanced scorecard. And I'll use the word appropriate a fair bit in these next few slides, and that is that we want to ensure as an organization that we generate appropriate returns. We don't want to make way too much, and of course, we can't make way too little. So it's very important for us to ensure that as an organization we have a healthy balance sheet so that we can generate returns and be viable into the future. So I'll start with deposits. We had a really good year in 2015 given the economic climate. We had about a 7.4% increase in our deposits, around $127 million. And we're basically bang on to what we planned or forecast at the beginning of the year. The chart on the left, I'll draw attention to, and for a couple reasons, because it might come up in questions or in subsequent slides. But if you look at the profile of our deposits, we have almost 3/4 of our deposits in variable rate deposits. So for us, that's becoming a bit of a risk, because if we're funding our balance sheet with variable rate deposits, interest rate movement can cause increased risk in our organization. So it's something that we're paying attention to. So if you notice that on the slide, again, I wanted to share that with you. So deposits fund activity, and it funds primarily for us loan growth. And as you can see in 2015, again, we had a really good year, And I would say, and qualify that, given the economic climate that we are in and continue to be in, we had some success around $181 million new assets, and primarily in the lending portfolio. So our assets grew about 9.22%, and again, we are just above budget by about $4 million. The chart on the left is, again, to give you an indication about what does the loan portfolio look like at Innovation, and it gives you kind of, I guess, an indication of the members that we serve. So on the left, you'll see that half of it is allocated or consumer-based type lending, and then the other part is commercial and ag for the most part. So about half our portfolio is related to consumers, the other is commercial and ag. And we've had some really good success in the ag area, so you see that increasing on a year-over-year basis. Okay, so deposits fund our loans, allows us to generate an appropriate return. And so our profitability in 2015, again, very sound and solid. Our margin between our deposits and loans was pretty bang on to budget. Our non-interest revenue, so the fees that we charge in our organization, was very close to budget. We did a really good job managing the expenses. So the organization that you guys own, one of the things that we're very conscious of is ensuring that we're managing it effectively, and we're managing the cost prudently. So we're about $700,000 better than budget when you talk to the cost to run our organization. And we had a really good year with respect to any kind of write-offs that we may or could have experienced as an organization. But we did come shy of budget, and the real reason for the shortfall in what we budgeted was related to our derivative portfolio. So I'll go back to the deposit slide. You know how we talked about we have a number of deposits that fund our loans, but they're variable. We have a bunch of members that like to go into fixed. So in order to make sure that we have proper risk in our organization, we do enter into contracts to protect that situation. So in 2015, we had a portfolio of derivatives that if we were to sell, they would be marked at a loss. So if you see the drop in 2015 as our profit, the main reason for that was the unrealized loss that we would have experienced if we were to sell those contracts. So I threw in another little bar on this to give you an indication of where our profits would be, again, if we didn't include those unrealized positions. And it's important to me to do that because I think if you look at an organization in an environment like Saskatchewan, you want to see growth in a number of different areas, and profits is definitely one of them. So those profits turn into a whole bunch of different things. And one of the I think the most exciting board meetings is when the board gets together and has a look at how well we did in 2015, and then enter into some process and some decisions on what we should do with that. So of course we have to make sure that we have a healthy balance sheet. So some go into retained earnings. We have to pay some tax, and then the rest gets allocated out or back in the form of patronage to our members. So when you look at the growth in our capital base, we grew our capital base by 11% by putting a good portion of those profits back into the balance sheet. If you look at our capital base differently, so if you take all of our capital and you divide it into our risk-weighted assets, which is an important consideration, again, we're well within the range that we like to see. So, when you look at 2015, we are now at a point where we're in a good situation, and we have that healthy capital base that I was referring to earlier. Last part of this presentation, or at least the scorecard, is related to risk. And a couple of measures that we look at there is delinquency in our loan portfolio. We look at that a fair bit. The other one we look at is the impairment. So if there's any loans in our portfolio that aren't doing well, we have to pay attention to and acknowledge. But as you can see, over the last number of years, we've been doing a really good job in ensuring that the soundness of our loan portfolio is also in a good spot. And you can see the trend, which is a good thing when you're going down. And we want to make sure that we continue to have this, this sort of level, which is very sound and market relevant. So hats off to the risk area for ensuring that we're working hard on protecting the potential losses of your guys' profits. So the business category, it has a number of different elements in it. We measure a number of different things in the business category. One of the things that we focus on a lot is the efficiency ratio. And I'm just going to go through a bit of a story before I get there. And we use the word efficiency a fair bit in our organization. And so the story I want to tell here is when I started in the credit union system, I guess it'd be about 5 years after I started in the credit system, I started to work for SAS Central, and we did a lot of consulting for credit unions across Western Canada. And when we worked with those credit unions, it wasn't uncommon to find a margin, an interest rate margin out there of anywhere from 3.8 to 4%. So just to really make that simple, organizations back then, they would give you 4% for your deposit, and then they'd turn around and lend it for 8%. And they get a spread of 4%. And it wasn't uncommon. But as you can see, that has changed considerably over the last number of years. At Innovation, our margin last year was 2.47%. So the story or the analogy I use in this slide is that if our organization existed back then of this size, we would have another $26.2 million in revenue to run our operation. So this situation is great for consumers because when you think about it, back then, if you're a consumer, you probably weren't happy if organizations were making 4%. Today, it's a lot better. It's at 2.47. But what that's done for us is allowed us to become more efficient. It's a really good opportunity for us to ensure that we're properly organizing and running our company. And so when I go through these next few slides, you can kind of see how we've worked at Innovation to ensure that our expenses in relation to the size of our organization are tracking in the right direction. Because we're a growing organization, so if you look at the bars, you're going to see that, of course, as we grow, we're going to have more costs, more salaries, more things that we have to pay for. But in relation to the size of our organization, you can see how well we're doing with respect to efficiency. And that's very important for a couple reasons. And that is, efficiency isn't just about saving money, and that is important, right? Because this is your organization. You've got to make sure that we're effectively cost conscious and not, compiling a bunch of waste. But the bigger thing about efficiency is it allows us to generate appropriate returns so that we can invest in the future, right? And so when I get into my other presentation around the future, it's a pretty important concept that I want you to think about, because if our margin went from 4 to 2.47 and we didn't have the chance to become more efficient, it would be very difficult for us to do the things that we do in order to remain long-term relevant. So it's a pretty big concept for us in our organization, and it's one that we use consistently. Being an efficient and a profitable organization allows us to do amazing things like this, and that is for in 2015, we're pleased to announce the highest payout of our patronage program. So it allows us to take a portion of our profits and reallocate it back out to our members in relation to the level of business that you do with us. Again, it's a fundamental element of being a credit union cooperative, and we're very proud to be able to continue with this program. And as you can see, as our organization grows, as we become more efficient and more profitable, it allows us to do things like this, because we do have a bit of a framework that allows us to pay back profits back to our members. And that includes a 4.6 cash dividend on equity accounts. And we also, a couple of years ago, tried to, bring some more dimension to this program. We also offer a $20 youth dividend, which has been very exciting for the kids in our organization, and they get to see this money enter into their account. So since 2001, we've allocated over $26 million back to you guys in the form of patronage. Again, back to Innovation allows us to do things like this, but it also allows us to invest in the future. So at Innovation, we're very proud of the things that you've seen when you walked into this building. We're very proud of the things that we've been able to bring to not only our current members, but also the members that that we hope to have into the future. Right? So we have to build a multiple array of channels in our organization in order to ensure that we're relevant not only today but long term. So I want to go through a few slides just to kind of, I guess, celebrate some of the innovations that we brought to the membership and to our regions. One of the big ones is freestyle, right? Profitable and efficient organizations can do things like this. They can go out and say, you know what, I have a hunch that you don't want to pay fees on a monthly basis. So what we launched was a freestyle account, and now you can do all that you would typically pay anywhere from $9 to $12 a month for free. Things like free e-transfers, again, is a very powerful thing for us, and we actually view it as almost real-time patronage. Rather than waiting till the end of the year to see what the number is, we've created a program that allows us to pay back and reward our members on a monthly basis. So we're very proud of that program. This is another part of our innovative schedule that we're very proud of, and that is what we call PFM, or Personal Financial Management. Because one of the things that we see in our industry is that we're not convinced that we're all doing a really good job of budgeting, especially the younger generations. So what we've done is invested in and embedded into our banking system the ability to budget and to track spending habits and to set up budgets and that sort of thing. So that's something that we're very proud of and launched. Remote deposit capture, the ability to snap a picture of your check rather than if you don't have time to go down and deposit, you have the ability to do that from the comfort of your own home. Actually, I'm just going to go back on that because there's some pretty impressive numbers. So in 2014, we had about 619 checks deposited for about $1.3 million. If you look at 2015, over 30,000 checks deposited for over $61 million. So it's a very relevant innovation that we brought to the membership and to the region. Our mobile app, again, has huge traction. The mobile app is, I guess, something that you can do or required for the remote deposit capture. But just have a look at some of the numbers here from 2014 and 2015. It gives you an idea of the adoption rate of our membership with respect to the mobile app, going from about 5,000 to 13.6. One thing that we worked on really hard this year was what we're calling innovation rooms. So all of our advice centers across Western Saskatchewan, so we have 22 locations, will be outfitted with innovation rooms. And what these rooms are, they're places where you can come and work with our staff, and we can do demos and show you how to learn the different channels and different ways to bank. But what's even more exciting about these rooms is, let's say that you're a member for us in Frontier, and you have a fairly complex question. It's maybe an estate question, and we don't have an estate expert in that location. Now what we have the ability to do is to facilitate a video chat where we can go into the innovation room. We can find someone in our network, anyone in our company that may know that answer, and we can get that answer to you right away. So we see this as a very powerful part of our, again, our suite of innovation that we're bringing forward. This next slide I'm not going to spend a lot of time on because we have a video for you at the end of the presentation to go through. 2016, I guess I'd define it as the things that we're going to do in 2016 is more of the same. We want to continue the momentum. We want to continue to invest in our people. We want to continue to invest in Omni and technology and build those channels so that not only the members of today can utilize, but the ones that we need to build for the members of the future, so that we continue to evolve as an organization. So what I'd like to do now is just pause and show you a video clip. And this is our year in review video clip, and this is something we'll be able to share for those who couldn't make it tonight. And we'll go through that. And then I'm going to change gears a little bit and talk about the future. So I have a number of slides to talk about some of the things that are impacting our industry.
At Innovation Credit Union, our vision is to be the most responsive and innovative financial services organization. To achieve this, we're staying true to our mission of providing world-class financial services wherever you are and whenever you need us. We've committed to continuous improvement so we can consistently give our best to our members and the community. Here's a look back at what we did in 2015. As a credit union, we're growing. We gained 587 new members, making our total membership 49,559 and counting. Our total asset size grew to $2.1 billion, an increase of 9.2%. This growth has allowed us to give back in even more meaningful ways. We gave back over $436,000 to local organizations who are doing good in the community. We funded over 40 students with $28,000 in scholarships and Spirit Awards. But it's not just the credit union that gives back. Our team of 404 staff members volunteered over 11,000 hours in our community. Staff donated $15,600 to various charitable organizations with the proceeds from our annual Dress Down Days. Our amazing employees make us who we are, so we made sure to invest in them. We invested just over $2,000 per staff member toward development and training to make sure that our team can perform at their best. The result? Our staff engagement score increased 8% from 2014, and we were named one of Saskatchewan's top employers. We stayed true to our commitment of putting members first by introducing leading-edge products to further improve member experience. Our members snapped pictures of over 30,000 checks using Deposit Anywhere, the newest addition to our mobile app. We launched Interac Flash to save our members time while making day-to-day purchases. Our members saved over $1.4 million in charges and fees through our Freestyle no-fee account. Since 2001, we've compensated our members with cash dividends and equity allocations totaling $26 million. In 2015 alone, members received over $3.2 million, the largest annual payout in the history of our credit union. And we're getting a lot of positive feedback. Our overall member satisfaction and net promoter scores were higher than any other financial institution in Saskatchewan, meaning those surveyed were more likely to recommend innovation over any other bank or credit union. We were proud to be named the 2015 Best Bank or Credit Union in the Prairie Post's 2015 Best of Swift Current survey. And we were named one of Saskatchewan Business Magazine's Top 100 Companies of 2015. We're proud of the strides we've made in 2015 towards achieving our mission, and we will continue on the path of offering world-class service, investing in our community, and prioritizing our members' first commitment.
Okay, while they're loading the next slides, I can tell what you're thinking. You're thinking, why did you just do the video? Save me a bunch of time. So we'll write that down for consideration next year. So I want to spend the next time with you talking about the future. And I really appreciate the ability to do this, because it's not very often you get to stand in front of your membership or your owners and talk about the things that are impacting the industry and the things that are impacting your organization, and have an open discussion around those sort of things. I want to make sure that everyone is aware that these are the things that are impacting us today and into the future. These are the things we're thinking about as we move forward as an organization collectively as a staff group, collectively as a membership group. But when you think about the time that we're in, I guess every organization can go through change. And typically, we're always dealing with some sort of change. But what we found, especially in our industry, is that technology is a catalyst that has taken change and turned it into disruption. And typically organizations, when they're dealing with change, they adapt, right? You adapt to certain things. It's pretty standard. There's lots of ways to adapt. But what's happened in our industry, and thus our organization, is that we're now, due to the disruption, due to the change turning into disruption, we're in transformational times. And so we spend a fair bit of time in our organization talking about those sort of things. And I want to take the next while here to talk about those things in our organization. And really the theme here is around velocity. It's around going from kind of linear change to exponential change. And I truly believe that's where we are as a society, and that's where we are as an organization. We have three drivers that we talk about in innovation: consumer behavior change, we talk about competition, and we talk about technology. And to us, technology is not only a driver, but it's also a catalyst that's causing exponential disruption in our industry and organization. I got a lot of slides to cover, so you'll see that I'll pace through some that that probably are just I guess, another way to look at the same information. So when I talk about disruption or I talk about exponential change and velocity, just have a look at this slide. You can see what they're trying to indicate here. And what it says is, how many years did it take for each of these innovations or each of these inventions to reach about 25% of the population? So if you look at the bottom, electricity took about 45 years. The PC took about 15 years to reach about 25% of the location. But I'm kind of setting the stage here for the smartphone, right? In 5 years, it reached 25% of the population. This is a good example of how we're seeing a lot of exponential change. And again, our view is that we're right in the middle of the start of that line when it comes to technology driving a lot of this velocity. As an example, just look at some of the things that you and I take for granted a little bit. For example, data storage. In the 90s, it was $569, for a gigabyte. Today, it's 3 cents. That's the kind of change that we're dealing with. That's the kind of example that I want to mention throughout my slides over the next while. So there is disruption ahead. We worked with an individual called Peter Sheehan, and he works with organizations across the world, fairly large organizations. So we're very lucky to have him come and speak to our staff a few years back. And in his research and in his work, they went back in time and they looked at all of the industries and companies that were significantly disrupted or no longer in existence. And what they found was there was not an example where that company didn't at least talk about the thing that disrupted them to where they ended up, whether that was not in existence or bankrupt. So when you look at these sort of things, which not too long ago were pretty common in everyone's house, have now taken on a new form. Right? The number one place to get music is through Apple. Right? You got Kindle. There's not very many people that don't utilize things like Netflix. So the disruption in those industries were very significant. And the other example I have here is the Kindle example. So e-readers came out. In 2008, they allowed downloading onto their product. In 3 short years, they were selling more books than they sell online in all the bookstores. And once these things happen, it's very difficult to go back. And consumer behavior drives a lot of that. So I want to talk about consumer behavior and some of the 3 or 4 disruptors that we are paying attention to as an organization, because again, it wouldn't be, it's our job to ensure that we're paying attention to the things that could disrupt our success and our long-term viability as an organization. So let's look at some consumer behavior. We'll talk a little bit about some of the demographics. I don't want to get into a lot of detail around demographics because, again, I'm not an expert. All this information is borrowed from, experts in the field, Deloitte, E&Y, KPMG, World Economic Forum. So they're pieced together in order to try and tell a story around some of the disruptors in our organization. So some of the age categories or demographic categories I'll talk to are on the screen. You've got the greatest generation, born before 1946, and then you got the far right, which are people that are born kind of after the year 2000. So those will be my kids. Now for me, I'm kind of more visual, so this gives you an idea of the people I'm talking about. So when I'm going through and I'm calling a category Gen X, Gen Y, you'll see what I mean. And I always try and find ways to get my kids into presentations, so you'll see them as the millennials that I'll talk to in a little bit. The other thing you want to pay attention to is Brad Pitt, and I'll tell you why in a little bit. If you look at credit union members across the world, Canada has the most mature statistic with respect to their other countries. As you can see, about 53 is the average age of the credit union system in Canada. That just so happens to be the age of roughly of Brad Pitt, so that's why I wanted to mention that. At Innovation Credit Union, we're pretty similar to the Canadian average as well. We're kind of around that 54. But the real issue here is that 10 years ago it was 37. Right? So that's really the thing that I want to talk about is the fact that 10 years ago our average age was 37, now it's 54. So what are we doing to position our organization to ensure that we have built the proper channels for categories like the Gen Ys. And so why are the Gen Ys important to us? Because by 2017, they will have surpassed baby boomers with respect to earnings. And by 2023, they'll have surpassed the Gen X's. So that's important in Innovation Credit Union, because we have to make sure that if they are now becoming more important, more of the people that will be borrowing more or purchasing more, we have to make sure that we're relevant. We've built the proper products and services and the channels for them to do banking in. And let's talk about millennials. Very interesting group. Not only because I have a couple and I watch them lots, but they don't view technology as a disruptor. They've always been a part of a smart screen of some sort, and they really don't know what an encyclopedia is. So it's to me one of the things that we talk about a lot as a family. So do we try and make them act like we do, right? Or do we try and understand their behaviors and evolve? So if you look at how the millennials act and go about their day-to-day, it produces what they call outliers. And this is a guy named PewDiePie, and this guy is ultra annoying. If you ever go online and watch this guy, he's a very annoying individual, but he's an outlier. The millennials love outliers. If you look at, I've used this slide a couple years in this sort of a presentation. So 2 years ago, he had 32.8 million subscribers, and he had about 6.5 billion views. So a couple days ago, I went online just to see how he was doing. I thought, well, it must be kind of a flash in the pan, a bit of a fad. He now has 43.2 million subscribers and over, 11.7 billion viewers. So why am I telling you this story? The thing is, when this guy features something like an app, typically the next day it's the #1 downloaded app. I don't have a lot more statistics around the millennials, but here's some interesting things related to the banking industry, right? So some of them actually believe they won't need a bank at all. 1 in 3 will consider moving institutions or credit unions in the next 60 to 90 days. One thing that stands out here is 71% of them would rather go to the dentist than to go to a bank. Right? So this is the things that we need to start thinking about now as we see this group move into the more mature state, throughout time. I won't fire up this video, but what this is it's a YouTube video, and you pan in. It's a rock concert. There's 60,000 kids in this rock concert. You pan in. Once you get closer to the stage, you actually see that they're actually watching a hologram. Right? So there's a hologram on stage, a 3D hologram, and so these people, these millennials, these Ys, have actually paid money to come to a rock concert to see a hologram. And so why am I telling you this story? Well, do you think that in 10 years, or do you think if we're trying to appeal to that group, that they think that human contact is all that important? Right? So this is the shift that we have to pay attention to. And again, it's not going to happen tomorrow. It's not going to happen in a couple of years, but these are the sort of the things, these disruptors that we have to start thinking about as we make sure that we're long-term viable as an organization. So let's move kind of that consumer behavior into something more close. So let's look into the Canadian banking industry, and then I'll finish off this section talking about innovation consumer behavior. And this is 2012 numbers, and I'm showing you these slides for a couple reasons. One is so you can see kind of the significant shift that's happening, but I also want to talk about the difference between simple and complex. So if you look at this, in 2012, you've got Canadians' main banking method is, if you add 10 and 47, 57% is either online or mobile. If you dig further into the study, you can see that it kind of makes sense, right? So people are still saying in 2012 that 82% of the complex transactions, I want to make sure that I'm going into a location. On the next slide, again, makes sense. The simple stuff, I'm okay doing, potentially on the internet or potentially on my mobile device. But still 65% of Canadians are looking to do that in 2012. So if we go back to the branch banking example, and so we surveyed some Canadians, and if you look at the change from 2000 to 2014, We now have 13% of Canadians surveyed identified that branch banking as their main method. Now this is down from 29%. So you can see the trends happening, and again, if you go back to the initial couple slides, it's the velocity that concerns us or myself around some of this changing behavior. If you talk about online banking, so more PC-based banking, we have more than 3/4 of Canadians report using online banking in 2014. But if you look at the last bullet, this is where it starts to get a little bit more interesting, because yeah, I get that for the younger group, but we're starting to see this activity in all categories. So online banking is popular amongst Canadians. 57% of between 18 and 34 say online is their main way of banking, and now we're getting close to half of those in and around 55. So we're starting to see a shift even in that more mature category. This one here is where you're seeing a lot of velocity, a lot of exponential shifts. And that's mobile banking, so banking on your phone, essentially. And just look at the date on these slides. So 5% was using mobile in 2010, and just in 4 years it's up to 31%. This next slide even, I guess, exaggerates a little bit, because in Canada it looks like we're fairly far behind other countries with respect to the adoption of mobile. But again, that to me is one of those situations. As soon as we start to get comfortable with that and we start to see more of it happening, we're going to start to propel even faster into the usage of mobile. If you go back to one of the slides I showed you in the earlier presentation, you've seen how much mobile adoption that our members had. So let's talk about that a little bit. Let's talk about innovation, credit union member behavior, just to kind of give you some context. Because a lot of times, I'll share some of this information and it's like, yeah, Dan, that looks good, but that's probably Canadian. That's probably down east, or maybe it's probably some U.S. statistics. So we did some work here at home, and this first, I know it's kind of a busier map, but really what it shows is the trading area of Innovation Credit Union. So we're essentially on this west side of the province, in and around here and in and around here. What we found, though, is that when we looked at it, see these other dots? Those are also members that deal with Innovation Credit Union. In fact, if we added up the business in those other dots, they become our third largest branch. So it's a very interesting, I guess, bit of information as we were doing our research. You can see how our in-branch type activity has tapered off, and you can see how our member direct or online banking is starting to widen with respect to the number of transactions or activity. This is, again, a very powerful slide. Innovation member activities back in 2001, as we move into 2015, you can see how the behavior has shifted significantly. There's actually a couple slides I'm going to show you that indicates that we're almost, and it doesn't surprise me, because I believe that the people of innovation, the members of innovation are a lot better than our competitors. So it doesn't surprise me that we're adapting or adopting things a lot better. So if you look at a survey that we conducted, and unfortunately these slides don't show up very well, or these bars, but a survey that we conducted with our membership, we said, how would you prefer to do your simple transactions? So of course online in 2014, pretty high. Simple transactions right around here with respect to branch, and mobile was here. So if you look at 2015, which is the blue bar, you can start to see that even the simple transaction on your PC are starting to wane off. But the real big issue here, or not issue, but the observation, is that the mobile is picking up speed. The other thing is, you're seeing where the activity from both online and in-branch are starting to go to the smartphone. So let's look at complex. So again, we surveyed in 2014 and 2015, and we had some research back saying that, of course, complex, we want to see, a person, we want to see in the branch, but they're starting to see some significant drop-off there as well. And then you're starting to see a little bit more online. This slide, again, gives you an indication of how our members here in our organization are doing relative to our peers. And so, as you can see, our adoption rate is significantly higher than others. So again, I would say exponentially higher or nonlinear adoption rate of mobile technology. Another quick slide just to kind of illustrate some of the behaviors of you and I as we have launched certain products. So for example, when we launched the Freestyle, we introduced free e-transfers. So if you needed to get money to someone and you didn't have an opportunity to provide them cash or write a check, you can email that or text them the money. And we decided to provide that for free. Our supplier charges us for that, and we've passed that on to you guys for free. And you can see how that's worked for us. So right here is when we launched Freestyle, and you can see what's happening with this activity with respect to e-transfers or moving money electronically. So again, I go back to, to that story around efficiency. We believe that it's not a bad option for our members to get comfortable and do simple transactions more in those channels that we have in our building, freeing up time for our staff in our locations to do more complex transactions, freeing up time for our staff in our locations to be able to spend more time with you providing advice. So we see this as a good thing, and we're not about to change consumer behavior. We're looking to adapt and evolve with the changing consumer behavior. And it kind of goes back to why we spent so much time on what we call our Omni strategy. So Omni to us is really about creating channels for you to bank with Innovation Credit Union, right? And you might choose branch, you might choose call center, you might choose ATM, you might choose mobile app. And we want to make sure that we build all of those for you guys and also our future members. So that's really what Omni is in a nutshell. And why is it important? Because if you look at research, 90% of Canadians said banking at a time that's convenient for them is very important. Down below, 77% of value banking, or they value banking from banking just about anywhere. So you can start to see some of this research actually embedded into our vision, mission, and values. So when you look at ease of doing business, this is paramount for us, because we believe you don't buy a mortgage, right? You buy a house, right? You don't buy a car loan, you buy a car. So anything that we're doing to delay that purchase or get in the road is strictly friction. So there's a couple more slides here before I get into the next disruption, and that is some news releases of some pretty big companies that are no longer around. And some would say, yeah, well, that's just due to competition. But it's a different kind of competition. When you look at Target, when they had to close down and leave, a lot of people said, well, yeah, they should have known. It was Walmart's going to make sure that they're not successful. But the reality with Target was they didn't pay attention to the fact that consumer behavior has shifted. Right? If you look at some of the information here, $30 billion last year was spent in e-commerce, so people purchasing things online. Right? They're looking at double-digit growth in e-commerce over the next number of years. So what Target missed, it wasn't necessarily that they had a bunch of competition. We just have way too much retail space with respect to Target / Walmart / that kind of business. So these brands that are fairly well known, to me, it's not necessarily about competition. It's that they just didn't recognize the change in the consumer behavior. So let's talk about competition. So competition for us was pretty typical, right? For a long, long time, we had the big banks and we had credit unions, and we always competed, and that was pretty straightforward. But then came along things like fintechs, right? So the competition got larger. Then these new entrants called fintechs came in, and really, what fintechs are, they're technology companies that want to get into the financial services industry. They want to disrupt the financial services industry. So this, if you look at this evolution, we went from this to the fintechs coming in, but now you see that bubble of fintechs getting even larger. And the other thing that's compelling about this is that not only is the bubble of fintechs getting larger, but the banks are evolving into quote-unquote fintech type activity. And if they can't do that, then they'll just buy them. So it's becoming a very interesting landscape when it comes to competition. So if you look at these name brands, and I had this slide probably 4 or 5 years ago, and in front of groups said, what do you think? How long till these guys get into banking? And back then it was like, well, maybe, potentially. But you have to keep in mind, these companies are bigger than countries, right? So if they want to get into banking, if they want to come into our space, I think they just might do it, and they might do it fairly well. So I was getting a lot of kind of, potentially, maybe. And then in the next slide was this one. And it was actually the press releases of all of those companies getting into what we do. Right? And if you look at a survey across banks in North America, these are the brands that they're most concerned about. In 2014, there was 1,400 startups in fintech looking at payments. And why is that important? Well, if you look at the credit unions and you look at financial institutions, 47% of our profits relate to payments. Right? So if you have our checking account with us, if you have our member card, those are things that typically mean that we have the opportunity to have more discussion with you, build more business, ask for more business. But if we don't have that, then those opportunities are at jeopardy. So it's a very important consideration for us. So I use this analogy. And I don't know if it's exactly how it'll turn out, but I have a hunch it's going to be something fairly similar. Remember in a number of slides ago I talked about the impact Apple had on the music industry. And this is a slide of the impact that they had on the music industry. So this gives you the time frame, right? There was vinyl. They kind of went away. Then cassettes came along. And then CDs. And then Apple started. And look what happened to the music industry. Right? The number one place to get music now is Apple. My view is that if Apple decides to get into our business, they could do the same thing with respect to banking or payments, right? So you got checks, they're kind of dwindling. Cash, they could be under the same sort of scrutiny. Cards, potentially, if Apple decides to, maybe allow you to do payments with your phone. So to me, this is a pretty similar and very disruptive description of what could happen to the financial services industry. So just look at some of the statistics. Just in the last hour that we spent together, these are some of the things that are happening, from the fintech side of our industry. $28.4 million was processed in the last hour by PayPal. So there's a lot of chaos happening out there with respect to competition. Technology, remember I talked about being a catalyst. It's also a disruptor because I think it both disrupts. I view it as friend and foe. So for me, technology is great because we'll be able to build things, become more efficient. We can make sure they're relevant long term. So I tell the story about when we were merging with East End Credit Union, and we're doing some meetings, and I went into the broom closet of the town hall. And the town hall is very similar to the one in my hometown. Your typical older hardwood floor and, fairly old building. But we went into the broom closet looking for a cord. Here was this amazing apparatus coming into the building. And so we're trying to figure out what it was. What it was fiber optics. Fiber optics was coming into this hall because attached to the hall was a part-time regional library, and SaskTel mandate is to get fiber to all the communities. So I was thinking, well, this is great because now the East End Advice Center is going to have fiber. We're going to have strong banking speeds. There are going to be limited lineups. Then I got thinking about the other side. So overnight, they now have high-speed internet. So our competitors, the fintechs of the world, now can be on our doorstep overnight. And so when we're competing for business and for rates, we're now competing for the world versus just the financial institution that's in that community. So technology, again, is something I think we should spend some time on. So I'm going to go through a bit of a riddle. So you can tell me what this is. It's a network computer. It's more powerful than all of NASA in 1970. It has the same power as a $34 million Fujitsu supercomputer. in 1993 and had 30 times the computing power of Bank of America's data center. So who knows what this is? That's right. That's your phone. Right? It's ubiquitous, it's addictive, and it's transformative. And so I want to spend a bit of time on this because this to me is again, a huge disruptor for us. So when you look at the adoption rate here related to computers, you can see what's happening. By 2020, 80% of all adults in the world will have a smartphone. Just in the past 20 seconds that we spent on that slide, 1,000 smartphones were shipped. And again, it's not only about the smartphone, the fact that it's a connected supercomputer that you can take anywhere. It's actually truly the first personal computer. You can't see these very well, but the other thing that compounds this disruptor is cheap data. We talked a little bit earlier about cheap data. In 2005, mobile megabytes per second was around $8, and today it's less than 5 cents. So if you take an amazing supercomputer and you give it cheap data, what do you have? Well, you have success for those who want to sell smartphones, but you also have a huge amount of disruption. And I would argue that data for a smartphone is getting close to being free. I have a friend that had a smartphone long before I did, and he never had a data plan. He just used Wi-Fi. He'd go to Timmy's, he'd go to different places, and he essentially could communicate. He could call, he could text by just using other people's Wi-Fi zones. And you think about it, we're getting to the point where it's basically going to be free. So that produces some interesting elements, right? So photos uploaded to Facebook in 2014 are greater than all of history before 1960, right? Cheap data, supercomputer, and exponential growth. So 10% of all the photos in existence were taken in the last 30 to 60, 90 days. If you look at what the phone has done for the bottom two slides, Uber, which again is getting a lot of press these days, is a household name in 55 countries, but it's only 5 years old. The smartphone has propelled it to that stratosphere. There's an app called WhatsApp. It was founded in 2009. It handles 10 billion more messages than all of the texting per day. So it's pretty compelling and exaggerated examples. But again, it's designed to get people thinking about the disruption that can occur. But here's an interesting statistic from Deloitte did some work with the World Economic Forum. 67% of bank IT budgets are still spent on upkeep and compliance rather than dealing with some of this potential disruption or projects that add value. So when we talk about the branch of the future and what's it going to look like, our view is that just changing the look of our branches or our advice centers isn't what we're looking at, because we're in the middle of a consumer behavior shift. So we shouldn't be talking about the branch of the future. We should be talking about the banking channel of the future, which again will be the smartphone. And really, when you think about it, banking isn't something, it's not really a destination, right? Banking is something that you do. So let's go a little bit deeper and then I'll move on to the next one. And it really becomes about, so now that you've got 80% of all adults with a supercomputer with cheap data, what does that mean? Well, it means you can create an app and do some banking, but it also means that we now have to figure out a way to engage with our members, right? Because now you have the ability to engage them all the time. Because when you think about some of the movement, Brett King, we had him come out to speak to our staff, and his research indicated that the average member in Canada will only frequent a branch 1 to 2 times per year in 2016. So if that's the case, how do we develop business and keep our relationships and ask for more business, if we only see our members 1 to 2 times per year? So here's the dilemma that we have to figure out, because the fintechs are figuring that out. They're actually interacting with our members 2 to 3 times a day. That's like 1,000 times a year that they're interacting with our members. So we have to find a way to, I guess, understand the disruption, but also the other elements of what this new banking channel of the future can do for us. And here's, again, kind of I view as a bit of a positive slant to what I was talking about. So if we've got 7.2 billion people in the world, 6.6 are mobile subscribers, 3 billion are internet users, which kind of makes sense. You're starting to see the PC at home becoming a little bit more irrelevant. But what's interesting is there's 2.5 billion unbanked, which means underserved consumers out there. Again, I believe that's an opportunity. Disruptor number 4, I won't spend a lot of time on this, only that it's been something that we deal with for a while. We respect this disruption, and we believe that it has value. So really what I'm saying here is that regulatory and compliance pressures will continue for financial institutions. And we believe as a credit union we shouldn't be a lot different. Right? We have your money and we're lending it out. So we believe that we should be regulated, and we are a highly regulated company. We're a highly regulated industry. So when the economic debacle came through our world, our globe, in 2007, after the dust settled, the IMF went around the different countries and they said, how well did you guys do? And they did report cards on each country. When they came to Canada, and arguably we did fairly well. When they came to Canada, they had 14 recommendations. 7 of them related to credit unions. And so really what we are is we're a product of our success. Right? We're a product of, we've done so well that we've grown in importance that we're on the radar screen, and I believe that's a good thing. So, but we believe it's a disruptor because we have to ensure that we have enough efficiency to make sure that we're properly making sure that we have a sound business to protect your guys' assets, to protect your guys' money. The last disruptor I'm going to talk about, it's a bit out there, I know, but when I see the launch of Facebook's message bots this year or this week, I kept these slides in. And really it talks about artificial intelligence. So the story I'm going to tell here is that, yeah, there's no way I would let a computer or some sort of artificial intelligence deal with me when it comes to my money, when it comes to banking. And I agree, today, probably not. But I know some kids in my house that would be fine with that. So we have to start thinking about that as we look at the members of the future. Because just look at this example. So IBM has a supercomputer called Watson, and they, when it comes to patient diagnosis, it has the ability to take, a whole bunch of patient information and a whole bunch of clinical study and a whole bunch of current data and compile it, and they're taking diagnosis from that used to take a couple weeks down to minutes. And in their recent study, they found that it was 90% accurate, and the human doctor was about 50% accurate. So if you have some sort of a dilemma or some sort of health matter, and you have the choice, I don't know, like who are you going to pick? So it's not that far off to think about the fact that, maybe someone would be okay with some sort of a computer doing some of this stuff for us, doing some banking for us, doing some transaction for us, and evolving and learning as we go. So there is a time frame to that. Okay, so when you look at this, you're thinking, well, what does that mean, Dan? What are you looking at for timelines? And so Brett King did some research in his view, and in the work that he did with credit unions in North America, is that if we don't have a digital or omni solution started by 2017, you're in trouble. So fortunately, we started back in 2013 starting to build channels and build things so that we can evolve as our consumers and our members' behavior changes. And if we haven't transformed our business by 2023, he's indicating that you'll be out of business. So to me, okay, you might be thinking, well, that's kind of doom and gloom. But there was one part of the slide I showed earlier that I thought was, compelling and something that's, I think, very advantageous for us. If you look at those millennials, all 4 of those, of the leading banks are among the least 10 loved brands by millennials. So what they're saying is that, 4 to 4 millennials, if you look at their view and perception of the banks, this is where I think where we can come in and demonstrate the value of being a cooperative and a credit union. So our reality back here at Innovation is that we started to transform. Okay, we've recognized the disruption. We've started to communicate and work with our members and work with our staff group to ensure that we're ready for this sort of disruption. We've reshaped our focus and our mission, vision, and values. We're creating appropriate returns. We have a nice, healthy balance sheet and appropriate level of risk that resides in our balance sheet so that we can protect that income going forward. And we've launched a number of things and started to transform. So when you look at where we are today, it's not doom and gloom. For me, it's very exciting. Again, Peter Sheen, who worked for our company a couple years ago, when he did research on our company and had a look at what we're up to, he was amazed. He said, your people are showing amazing resilience. Your members are showing amazing resilience. Not resilience to change, but resilience in that they're adapting to the change. They're adapting to the disruption that's happening in your industry, because it is very disruptive. So I think this is where I end off, but I just wanted to thank you for that. Because if we're in disruptive times, it's probably likely that disruption is going to impact us in some form or fashion, whether it's the most important stakeholder groups of our people or the most important stakeholder groups of our members. It's probably going to impact us in some way. So I want to thank you for that. I want to thank you for your business, and I want to thank you for the passion and the dedication you have for our organization. Thank you.